Throughout every era of history, there are 5 laws that humanity has faced over and over again. These laws are still alive inside your wallet today. You just don't realize it. Let's begin. Law 1. Gresham's Law. Bad money drives out good. You have 2 banknotes in your pocket. One is crisp and clean, the other is old and crumpled. Which one would you hand to the waiter? The torn one, of course. You keep the clean one, because instinctively you hold on to the valuable one and spend the worthless one. That is exactly what Gresham's Law is about. But if everyone does the same thing, what's left in the market? Only the crumpled, worthless money. The Roman Empire of the 3rd century AD was slowly sinking. Endless wars and relentless palace spending were draining the treasury. As a solution, the empire began melting down its coins, mixing in bronze, and re-minting them. The face value would stay the same, but the coins would contain less and less silver. In the short term, the plan seemed to work, but the people noticed. They hoarded the pure silver coins and spent the new debased ones. Only worthless coins began circulating in the market. Merchants demanded more coins for the same goods. The empire minted more. Inflation hit its peak. And it wasn't the barbarians who conquered Rome, it was this cycle. In the 16th century, English financial advisor Thomas Gresham gave this phenomenon a name. In a letter he wrote to Queen Elizabeth in 1558, he observed that both pure silver coins and debased coins were circulating in the market. Nominally, they held the same value, but people were keeping the pure ones in their safes and spending the worthless ones. This law holds true even today. Take cryptocurrency. Bitcoin holders don't spend their Bitcoin. They use dollars for daily expenses because they believe Bitcoin will appreciate in value. You don't spend the money you believe will grow. That is Gresham's Law in action. Another example, the 2008 crisis. Banks bundled good and bad loans together into packages and sold them to investors. The good assets were kept hidden, while the toxic ones kept circulating in the market. The result was one of the greatest financial crises in history. Law 2. The Cantillon Effect. Money enriches wherever it lands. Imagine the government announced a massive $1 trillion stimulus today. People heard the news and rejoiced, but that money reaches banks and large corporations first, and those giants use the stimulus to buy land, stocks, and foreign currency. Prices begin to rise. Then, slowly, the money trickles down to ordinary people. But by the time it arrives, prices have already surged. Now they can buy less with the same amount of money. So when governments print money, it doesn't distribute equally. Whoever gets it first wins the most. The public learns about it last through inflation. This is the Cantillon Effect. In 18th century France, there lived an Irish banker named Richard Cantillon. In his book, he wrote the following lines: "When the king prints new money, it enters the palace first. The palace spends it tailors, architects, and artists earn. They spend it bakers and butchers earn. The money slowly spreads through society. But with each hand it passes through, prices rise a little more. By the time the peasant, the laborer, the day worker sees that money, its purchasing power has already eroded." Cantillon didn't just write this as an observation. He had lived it firsthand. During John Law's Mississippi bubble, he bought shares early, sold before the bubble burst, and grew wealthy by his own law. In 2020, the world shut down due to COVID-19. Central banks printed trillions of dollars. Stock markets surged almost immediately. Housing prices made a stunning leap. Crypto exploded, and those who already held assets won. Those living paycheck to paycheck, renting their homes, with no savings they lost. During the pandemic, the wealth of the rich doubled. In the same period, millions of people lost their jobs. Cantillon had written this 300 years ago. Law 3. The Minsky Moment. Stability breeds instability. Think about it this way. For 2 years, everything has been going well. Your salary is coming in, work is good, markets are rising. You went to the bank and took out a loan. Your neighbor did too. Your friend did too. Everyone did. And at some point, everyone's debt has grown so large that a single small tremor will flatten the entire system. But no one is aware because everything had been going smoothly for so long. The moment everything looks its best is actually the most dangerous moment of all. Economist Hyman Minsky called this the Minsky Moment. Prolonged stability leads people to take on more and more risk, and that accumulated risk eventually explodes. 1920s America. The war was over. The economy was surging. The stock market was rising every day. Everyone was growing their wealth. Most people were borrowing money to buy stocks, assuming they'd sell higher later. Banks were lending freely because they viewed the stocks as collateral. Stocks were rising because everyone was trying to buy. Everyone was buying because stocks were rising. This cycle continued all the way to 1929. Then panic set in and stocks began to be sold off, but the market was filled with shares purchased on borrowed money. As prices fell, collateral became insufficient. Banks said, "Pay us back." People were forced to liquidate their holdings. Selling triggered more selling. Over months of collapse, a decade's worth of savings turned to dust. The Great Depression had begun. When Minsky analyzed this later, he wrote, "The crisis came unexpectedly, but in reality, everything had been building in plain sight." In 2008, the American real estate market had been rising for years. Banks said, "Housing prices never fall," and handed out mortgages to anyone. They packaged those mortgages and sold them. Other banks bought those packages. The system had grown far too large. Then a small decline began. The Minsky Moment kicked in. Lehman Brothers collapsed. Then, across the world, people lost their jobs. Yet for years in America, everyone had been saying, "This time is different." The Minsky Moment always arrives with the same sentence. This time is different. Law 4. Parkinson's Law. Expenditure rises to meet income. You got a raise, but a few months later, you looked and your savings hadn't grown. In fact, they had shrunk because you moved into a bigger apartment. You bought a nicer car. You went on vacation. You justified each decision with, "It's within my budget now." And at the end of the month, you arrived at the same result as before. This is part of human nature. Parkinson understood this in 1955. Expenditure will always rise to fill income. However much you earn, your spending grows to match it. Savings don't form on their own. In 16th century Spain, ships full of gold and silver were arriving from South America. The Potosi mines held enormous reserves of silver. Spain was the wealthiest empire in the world, and yet Spain went bankrupt repeatedly because every arriving ship financed a new expense. Wars multiplied, lavish palaces were built. As income grew, spending compounded. Spain consumed its own wealth, and when the silver mines slowed, a mountain of debt was all that remained. In oil-rich nations, as oil revenues grew, government spending grew with it. Subsidies, megaprojects, bloated public payrolls. When oil prices fell, dynamite had already been laid beneath the system. Nigeria, Venezuela, even Saudi Arabia at one point, the same cycle played out in all of them. This is the real reason every personal finance book says, pay yourself first. Because if you wait, expenditure will fill income every single time. Law 5. Goodhart's Law. When a measure becomes a target, it ceases to be a good measure. A school holds exams to measure student success. The principal says, let's set high exam scores as our goal, and so it happens. Teachers taught to the test. Students pass by memorizing the exam. Scores went up, but real learning went down. The moment a measure becomes a target, it stops reflecting reality, because everyone starts managing the measure rather than improving the underlying truth. Charles Goodhart said this about monetary policy. But this law exists everywhere in everyday life. In the early 2000s, American credit rating agencies Moody's, S&P were assigning scores to financial products. AAA was the highest rating. Banks started working toward getting AAA ratings, but they weren't interested in what the rating meant, only in how to obtain it. And since rating firms earned money from their ratings, they tried to keep their clients happy. As a result, low-quality, high-risk financial products received AAA ratings. Investors assumed they were safe. In 2008, the products exploded and the system collapsed. Goodhart's law had done its work. The credit rating, the measure, had become a target, and once it became a target, it stopped being a mirror of reality. Today, most corporate executives manage their stock price, not their company, because their performance is evaluated based on share price. Instead of long-term investment, they conduct stock buybacks. Instead of R&D, they pay dividends. The measure became the target, and real business was pushed to second place. 5 different laws. But in all of them, the same thing holds: human nature never changes. These 5 laws look set to hold their place throughout the entire history of humanity. If you found answers to your questions, wonderful. Keep listening to Wallet Historian, and I'll keep searching for answers.